wait for other people when they join. So I believe it's already been 5 minutes of waiting. Okay, I think whoever joins later will join later, and we will just start. So hello everyone, my name is Anna. I'm a real estate agent, and today we will talk about a real estate market in Dubai, and we will answer the main question: to buy or not to buy, and what's more important, Dubai or not Dubai. I tried to make it as short as possible. To be honest, I don't want to make it long and I don't want to dive too deep into details. So today we will talk about general, about fundamentals, why people invest in Dubai, who invests, historical data, economy today, how real estate market reacts to a shock, three possible scenarios that we are expecting in the future, alternative markets, and then after that you can ask me your questions, if any. There is chat box in this webinar where you can ask questions. So to start from very, very basic and fundamental thing, why do people invest in Dubai in general? Let's imagine that you have a friend, or it's you, or like has a lot of cash and doesn't know what to do with it, right? So what would be the reason why would be Dubai? Why it's not Western countries, why it's not Europe, why it's not Australia, why it's not any other country, why Dubai? So of course, first of all, because of tax-free um, tax-free environment, and zero capital gain tax and zero income tax. This is the main focus of international investors. Then, of course, capital preservation. Those countries that are less stable in their economies and their currency is less stable, they prefer UAE because UAE is USD backed, and such countries, for example, as Russia, because of the sanctions and because of loosening ruble strength all the time. Then legal security. We all know that investing in Dubai is very safe. We all know that we are protected by escrow accounts here, by DLD, and the whole market, the whole situation is very, very, very transparent. So for any kind of investor, it is very safe to invest here when all of the steps are followed correctly. Then capital mobility. Easy to transfer money in, easy to transfer money out, right? Nobody asks any questions, almost. Then, of course, protecting wealth from inflation. And this is one of the key reasons also why international investors are now, and before that, were investing in Dubai. And of course, lifestyle and residency. So in general, if we're looking at these reasons, and it's mostly why people invest in Dubai, it's economical reason rather than anything else. And as a benefit, we are getting also lifestyle. And lifestyle and residency actually started to be more and more popular after COVID times, but we will talk about it later. Let's look at the nationalities, top 5 nationalities that are investing in Dubai today. It is, of course, India in the first place, then UK, then Russia, Italy, and France. Each of these countries actually they have their own reasons and motives and triggers to channel their investment from their countries to somewhere else. For India, for example, it is overpopulated country. For UK, it's taxes. For Russia, it's sanctions, and Italy and France again taxes and prices for their properties in those countries. And of course, because to buy a property, first you need to show all of your income, prove source of income, and prove that you have paid all of the taxes before you can invest and continue paying taxes from your investment. Now let's move to historical data. What do I mean by historical data? To understand what is happening with the market and what's going to happen, and to give more or less as accurate as we can forecast, we need to look back at the history, what happened and how the economy reacted, and what was the economy before stress and before shock and before the crisis. And first, I want to show you how the market performed over the years. At the beginning, we can see this is still recovery from 2008 crisis. This is the maximum that I could capture from the open data sources. The screenshot comes from DXB Interact. This is our same as a property monitor. DXB Interact. It's basically our reference to all of the transactions, what is happening in the market. All of the transactions can be visible there as long as they are registered in DLT. So basically, if it's a secondary transfer or if it's a off-plan purchase, every single transaction we can see here. And this is how transparent Dubai is, and this is how we understand also what is happening in the market, and we can be sure if the property was purchased with this price or another price, without even seeing the documents of the property. So there is very interesting, like if we just have a first glance at this chart, there is a very interesting situation. Before 2021, we have like kind of okay situation, and 2021 and up until now, up until 2026, it is unprecedented growth, crazy growth compared to what was happening before. And this, what happened here, is a result of measures and certain reforms that were taken here. Right? We were 2017 to 2019, this was actually a recession. And over here, very, very important decisions were taken by the government, which made this possible. And in general, in let's say 8 years over here, also small changes were happening that eventually helped the growth that we had after 2020, after COVID. I will get back to this slide because there will be, I'll be going back and forth, but let's now talk about 2008 financial crisis. Why I'm talking about this? Because S&P Global gives a lot of references now and compares that situation to this situation, because probably it was the most painful crisis in the history, and understand what was happening before and during and after will help us to understand if it is possible that now we can repeat this painful history. And you will see if it's possible or not by yourself. So let's look at the economical indicators before crisis. The main one, of course, is UAE GDP, which is $260 billion to $315 billion. Real estate was 14.7% of the whole GDP. Oil was 40% of GDP. Oil price was 90% per barrel, and peak was 146 per barrel. Remember this number. Inflation, 11%. Population at the time, 6.3 million people. Peak of speculative real estate boom. Easy financing, aggressive off-plan sales, no escrow account as such, and DLD fee 2%. So what did we have there? We had very fast market, crazy inflation, very easy and cheap money that needed to invest, needed to go somewhere because inflation was crazy. And we had zero security for the investors from the government in terms of escrow. What does it mean there is no escrow? Today, for a developer to qualify for escrow account, what they need to do? The land has to be purchased with cash. It cannot be mortgaged. And 30% of the project value, not cost, of the project value has to be deposited into the bank itself by the developer. Why they are doing so? So basically they want to see that the developer has enough of liquidity to start the project and to build. And that with 20% down payment, they actually have full amount of the construction, because usually margin here 80 to 100% of the developers. So with 50%, with 30% from the developer and 20% down payment from the buyers, they have enough money to build, complete the project and to hand it over. That's why it's so important. So it wasn't there. It means if no escrow accounts, so how many lands were purchased with mortgage, how many of the developers bankrupted, and what kind of hit the banks took at that time. Very important. And DLD fee 2%, which allowed more speculations on the market. Today it is 4%. Then what was happening during crisis? GDP went a little bit down to $153 billion. Property prices went down by 50%. Liquidity collapse, project frozen, bankrupted developers. Aftermath. After this, it was a very big learning curve for several years when developers started to introduce after that increased DLD fee per transaction. Is now 4% up until now, and escrow accounts created as well as controlled inflation. So if you can see that this situation here, it already looked like a bubble, which of course bursted with 50% price decrease. Next difficult times that we experienced in the UAE market was 2017 and 2019, market correction. For this, I will just go back to my previous chart. In 2014, 2015 and 2016, we were experiencing the highest prices per square foot, 1,800 per square foot. Up until now, we reached 1,700. We didn't reach those prices. So why do you think the prices were that high? It is very simple. Crisis 2008 destroyed a lot of developers, and only the industry tycoons stayed who could build, who could deliver. And then we had spike after Arab Spring and Syrian conflict, and second spike was 2014 after. This is the beginning of Russian-Ukrainian conflict and Crimea. So these two triggers for foreign investors to come and to source for the safe haven, to bring their money somewhere, and Dubai was perfect for them. But what was happening in Dubai? Very limited supply. Very limited supply, and demand was all at the same time. It wasn't even the spread. It was just like one spike when people were buying. Then what happens? Developers start adjusting. Emaar at that time launches every week, every 2 weeks. All of the developers start launching more and more projects. But the demand surged. And then what we have here, 2017, 2018, and 2019, this was the recession years. Also during these years, we remember there was the conflict with Qatar. It was Qatar blockade. Qatari nationals at that time were also a big part of the market, and they were buying expensive properties. And then we entered this beautiful time here, when the prices were gradually going down. If you compare, by the way, 2019 market and 2020, there is no big difference here. It is 10% decrease in the market in the sales value only. Why? Because it was already slowly decreasing. COVID just gave another push for this negative trend, basically. But the trend was already negative. So what did we have? GDP, $403 billion. Real estate, still 15% of GDP. Oil and gas, 30%. GDP growth, 4.4%. Inflation, 2.3%. Very good. Population, 9.2 million, 50% more than 2008. Oil price, $100 per barrel. This is a very good actual situation. And the market's still growing. It's not a crisis market. Then we go to correction phase. GDP, 382, $421 billion. Growth, still growth, up until 3.4%. It's slow growth, but it's growth. If GDP is growing and it's not negative, it's not crisis. Inflation, though, this is very important. Inflation, 2% and minus 1.9%. Deflation in 2019, we actually entered deflation. So if we look at it, oversupply from the developers and the deflation on the other end. Deflation means your dollar buys you more now. Your dollar has more power. So with oversupply plus deflation, this is where we have the prices dropping. And it's normal for this situation. It's absolutely normal behavior of the market. Population up to 9.8 million, very good. Oil price 50-70 per barrel, not very good. And what we had here, introduction of VAT, 5%. So if we compare to peak of prices to 2014, prices dropped up to 30%, 15 to 30%. And that's why actually it seemed that during COVID, there was a big price drop, but it wasn't COVID, it was way before that. Oversupply across many segments, shift from investors to end users. Why this also happened? Why shift from investors to end users? What was happening there? So the thing is, before we entered COVID, before all of the reforms that were taken during this period of time, Dubai was highly speculative market. What it means, people were not buying property to live. People were buying to invest and resell. So basically, the treatment of the market was very similar to stock market, hence the volatility. And developers allowed resale on a much lower amount paid and lower construction phase. So for example, today, majority of the developers say like 50% of the property has to be paid, or even 50% of construction has to be completed for you to be able to resell off-plan property. Back in the days, it was much simpler. That's why it became not very interesting for speculative investors, and more end users were taking over the market. What else happened very important during it was end of 2019, the government introduces golden visa, 10-year-old golden visa. It wasn't yet implemented. It was implemented in 2020, 2021, but it was first introduced. And the same thing they introduced, like I think it was month difference when they introduced it, was 100% foreign ownership for mainland companies. This is a huge milestone actually in the economy. And this milestone we could see actually in 2021 mostly, because during COVID it still was, the economy was in crisis and it wasn't growing. But once it started growing, we could see the outcome of this decision. What does it mean for real estate market? For real estate market, it's very simple. It means international developers come into the market and start be big players. Because imagine if you have to have 51% local ownership, so you need to have a local partner. It is not very attractive for a developer. It is too big of a share to give, right, to the local partner. And not necessarily you will have the partner who will be equal partner to you, right? So most of the time it were just people who were basically in a license, but they were not participating in a business. So that was very risky for developers. And after that, we could see how the landscape of the development in Dubai changed. How many developers we have right now? It's 2,000 registered companies as developers. Not all of them actually are performing big developments. Some of them are just like, I don't know, built one villa maybe. But still, this created, it's just expanded the market a lot. And then we are going, of course, to COVID-19. Pre-crisis, it was already not too good, to be honest. Pre-COVID, it was not too good. GDP, 349 billion, minus, it was during COVID, it was minus 6.1%. GDP per capita, $36,000. Inflation minus 2.1, again, deflation. Population 9.3 million, some people left. Oil prices dropped below 20. But with all of that said, with all of that crisis economy, people live in the country, very bad oil prices and deflation, prices for properties dropped only maximum by 10% on average. Right, so of course there were somewhere drops 5%, somewhere there were drops 15%, but on average we can see it's like minus 10%. This already shows that, first of all, the economy was already much stronger rather than during 2008 crisis, and it's not the same. So escrow accounts, of course, much more protected investors, developers, banks as well. So banks are not in risk situation anymore because, again, because of escrow accounts, they made sure that developers have money to buy the land and build almost all of the project with their own liquidity. If the developer has money to build, he doesn't need to drop the prices. He can build and then sell, and he will sell actually more expensive rather than during the construction. The adjustment was happening mostly in the secondary market. And again, it depends how the investor, how the owner of the property feels. If his business was making money and he wasn't losing, he wasn't desperate, he wasn't selling, he was buying actually. But because we entered the situation before with the prices versus the growth that happened later, it seemed like the dip was very big. Now let's go to recovery phase. Recovery was something as like a miracle. But again, it's not a miracle, it's not luck, it's not by chance. It's set of calculated moves and decisions were taken prior to the crisis, and they were supposed to boost the economy that was already in recession. But taking all of that, plus you use the momentum of COVID and turned it actually in their benefit, in their advantage. All of this combined together gave us this amazing recovery. First of all, it was very fast compared to crisis in 2008. It was in 1 year, the market completely recovered. So let's look at it. 415 billion to 507 billion GDP, growth 7.9%, per capita 47,000, 45%, which is okay. It was worldwide inflation around 5%, and we all experienced it and felt it. Population grows to 10 plus million. People started coming here out of a sudden. Oil price recovery, $70 to $90 per barrel. Prices grow 30 to 60% on average. But again, there were certain areas where there was 300% growth. They were so undervalued or launched at the lowest time. And let's look at the situation today. Today, the GDP growth is 4.5%, non-oil sector 70% of GDP, inflation 2.5, 3.5 pre-conflict, GDP per capita $50,000 to $53,000, highest ever. Oil was at 80% per barrel. And today, 50%, 55% of real estate buyers are residents. And this is one of the most important things. Population, 11.4 million. And another very positive number that we can look at is 184% of GDP is a reserve of UAE for the situation like that. Sorry, somebody is messaging me. So today, the state of economy of the UAE is one of, like, it's actually the best it has ever experienced. There are reserves, there is money to support, there is everything over here, and most important, that the demand is growing internally among the population over here that lives here, that works here, that stays here all the time, residents. This is one of the most important things. So we don't have any more market speculators. We don't have any more investors that just need to save their money. I mean, it was 90%. Today, they are less than 50%. So real estate market and economy in general are much stronger and healthier than it has ever been, to be honest. And in light of all of this strong economy, let's look at where Dubai stands in terms of price of the properties. Because you say, okay, but maybe we reached the peak. Maybe we did, maybe we didn't. It all depends on what are the choices the investor has to support the goals that I discussed at the beginning. Today, Dubai is not even in top 5 most expensive cities in terms of properties. So on the first place, it's Hong Kong. It's, by the way, another place with zero taxes, right? Hong Kong, 9,000 per square foot versus Dubai, 2,000 per square foot. 2,000 is not average, it's median price. So it's median prices here. Then Singapore Marina Bay, 7,549. Actually, people from Singapore, investors from Singapore, they are selling their apartments over there to buy villas in Dubai. And then if we look at London, 6,143, New York, 6,121, Paris, 4,345, and Toronto, 3,144. And Dubai is, trust me, economically is performing better than Toronto for sure, and better than France, but the price per square foot is still lower, which there is still, if you're an investor, there is still room for growth if we're comparing to global markets. But again, this all was during a peaceful situation. Now let's just have a look how market usually performs and how it takes this kind of shocks, right? So first phase is a market shock, which is up to 1 month. This is what we're experiencing right now. People just stopped buying, selling anything, right? So it's just shock. Then from 1 to 3 months uncertainty, demand slows, buyers seek clarity, leading to early discounts. To be honest, we are already entering this phase faster than it is faster than 1 month. Then 3 to 6 months is an adjustment. This is usually when sellers of secondary properties are accepting new reality. 6 to 12 months, it's big fear in the market. This will happen in case the conflict continues, like this scenario, if in case the conflict continues several months to several years, right? So for this to happen, we need to see significant change in the economy in terms of we need to see a lot of businesses bankrupting. We need to see a real crisis. And then recovery, 12 to 24 months. So what does it mean? For off-plan investor, it means that anything from here to here, you're good. It means after 1 year, you will start making money on recovery. Because the best time for off-plan is here. Do you know why? Because that we are entering right now. Because there are many planned launches that they cannot cancel anymore. They already paid for labor. They already paid for labor camps. They invested already a lot. They can't call them off just now. They need to give discounts. And here we have the best negotiating power. Here and here, they can postpone the projects. They can cancel them. They can sell the land. They have time for these ones. But here, they have something in hand that they need to sell. This is not going to happen to Imar, or this is not going to happen to Dubai Properties. But there are developers that later I will tell you about that have already certain discounts. One of the best things that probably worth mentioning is Imar stock prices, because I love media. The way they are just speculating. Media knows that 90% of the people only reads the headlines and they will never open the article. They know this, and this is how they work. To be honest, for media, this kind of situations are golden days. This is their best time, and this is when they make the most traffic. So they will use any kind of headlines, any kind of hooks possible to make you buy, to bring the traffic to their resources. So whatever they say does not necessarily need to make sense, because their goals are different. Their goals are not to inform you. Their goals are not to make sure you are, the correct information. Their goal is to make you click. That's it. So whatever makes you click, they will post it. But because 90% of the people, even if they click, they won't even bother to read the whole article, they create this panic in the market that something dramatic happened. What dramatic happened? Imar stocks went down by 30%, from 17 per stock to 11.95, right? But if we look at this chart, we can see that in 2014, when the prices were for properties higher than they are now, when price per square foot was higher, when demand was crazy and supply was low, and it was like a really high competition for the buyers, stock market was even lower than it is now, than it now felt. So how is this the strategy? How is this the crash of the Dubai real estate market? How does it indicate anything? It doesn't indicate anything. Plus, the recovery already happened. 8%. It recovered by 8%. Why it happened? Because they had launched last week for Imar South, and they sold 80% of the project in 2 days, which is amazing. I don't know if they have anything available right now, but if you want, we can always look at it. So this is what I mean by media. There was another article by Reuters yesterday that someone is selling their Burj Khalifa apartment 50% down from the value, and there is no source, there is no proof, there is no nothing, and their trusted source is, we heard from a real estate agent. Literally, we heard from a real estate agent, and we saw in WhatsApp group. This is basically how they back their data right now. Possible scenarios of what's going to happen. I didn't make it on this slide because I just want to talk about it. I don't want to. Obviously, we don't know. We don't know what's going to happen geopolitically, how it's going to turn out. But of course, we can probably see three main scenarios that are going to happen. Scenario number one is a long term. A long term means a year or even more of the conflict. This, of course, will create economical problems. Of course, it will be crisis economy, and of course, in this kind of scenario, the prices will go down. But how low, it is questionable. If the conflict is long, but it's not escalated all of the time, life gets back to normal somehow. Like, for example, in Israel, the prices for properties were growing even during the conflict. Why? Because people get used to it. And people get used to anything. It just adjusts until a certain point and then stays there up until the conflict is done. And then it depends on how the economy will react. But this scenario is probably less likely to happen based on what's happened yesterday and today. Another scenario is amazing. Is mega positive that conflict finishes very soon. Then from April there will start negotiations, and in diplomatic way they will finish the conflict and sign their agreements, which will guarantee security and safety for Gulf countries. Which possible, very, very optimistic, but I think it's just too positive. But if it happens, what we will see in the market is the delayed demand effect. What does it mean? Those people who stopped buying for 1 month, they will start buying. And those people who wanted to buy end of the year, they will start buying because everybody will understand the prices will spike. So if this happens, if this very positive scenario we're going to work out, we will have crazy spike after a couple of months. And the scenario is somewhere in the middle, and probably more realistic that the conflict continues a couple of months, then it finishes, and then market takes some time to adjust, stabilize, and recover. And in this case, we can see that it is safe to say that after 1 year, we will start a recovery stage as a whole in the market. So my advice would be, if you just hold cash and you want to maximize your investment, you want to maximize as much as you can, I would advise to wait for a couple of months and to see how the movement is happening. And locally, I would say not to probably observe the whole market, how it's going, but locally to see from offer to offer what kind of offers we are getting. Because if to judge by 2019 and 2020, what can we have? Like S&P Global gave their projections that 15% is maximum what is going to happen to the market. And I also think it's not going to be very dramatic for very simple reason. Since after 12-day war, every single month, Khaleej Times, Gulf News, and all of the media were releasing same article saying that we are expecting market correction for 15% by the end of the year or beginning on 2026. Maybe they were already preparing us that there will be this kind of conflict. Maybe it is just calculation based on demand and supply. Maybe, I don't know, it could be all together. But government has already put into their budgets, right, that 15% correction is going to happen. And now, actually, it is for those investors who were waiting for the correction, it is a really good time to start looking for something and start making offers to secondary owners. In case you want to buy off-plan property, as I said, now starts a really good time to negotiate with the developers. And there are many ways how we can do it. One of the options is that we can make a bulk deal, make a group of investors of 10 people and come to developer and just ask for a discount. They were not allowing it to do last year because they had crazy sales, all of them. But this year we can leverage on it. Or we can go by one, just see what best we can do. The best discount would be, of course, in a bulk deal. But anyways, let's move further. In general, I would say for any kind of scenario is going to happen, long, short, or mid-term conflict, it is safe to say that the economy is stable enough to take the hit, and it's not going to crash tremendously like it was previously during the 2008 crisis. Because today, economy is stronger than ever. So in terms what it is for you as an investor, it means that the only reason why it might slow down, right, and it will slow down, is the conflict. There is no other reason. The other reasons for investment and the other benefits, they stay here. Moreover, I think we will have actually more time of tax haven in terms of income tax and capital gain tax because of the situation, because it slowed down and paused us for some time. Maybe we'll have other different benefits. We don't know. But trust me, UAE government, they have been preparing for this moment for a long time. And we can also see it by how fast the solutions were found. For example, on day 3 or 4 of the conflict, they already have started to use the Etihad rail train for transporting goods, because there is a port in Abu Dhabi, there is port in Ajman, and there is port in Fujairah, which doesn't pass the Hormuz Strait, and the goods can come to Fujairah port and then taken by train to other Emirates. So it's not an issue anymore. Next, I promised would be alternative markets. To be honest, there are many alternative markets that we can look at. There is, of course, there is Europe, but in Europe, I would say Switzerland. Switzerland, it is just for basically saving your money. The ROI there is 3%. Capital gains would be like 1-2%. It's not as attractive as riskier markets, but it's super safe and stable. But 2 markets that I would like to talk to you about right now is Thailand and Oman. So first about Thailand. Thailand will be attractive again for those who are seeking to invest their money to get good ROI and to not be questioned, I would say. Thailand, in particular Phuket, is mature tourism-driven property market. Prices reach $6,000 per square meter, $6,000 per square meter. ROI 7 to 12% on short-term rentals. It's net. Strong international tourism, digital nomads, long-stay residents there. Foreigners can own also properties. It's predominantly leasehold. However, there are also freehold properties only in condos, and up to 49% of the properties in condo can be sold to foreigners as a freehold. Land ownership restricted though. So for land, it's only leasehold. However, there are some taxes there. There is annual property tax up to 0.3%, higher for vacant land, rental income tax up to 35% progressive, 30% standard deduction allowed. And on purchase fees will be actually a little bit lower than in Dubai, it's 2.5%, but if you resell your property before 5 years of owning it, you pay another 3.3%. Pros and cons, I would say, in Thailand market. Thailand has lower entry ticket, much lower than Dubai. And you can get your property like very close to the beach. It is all year old tourism. It's like all year high season, basically. Weather is amazing, but resale market is very, very difficult and slow. In fact, I have a couple of clients that are trying to liquidate their properties in Thailand already more than a year, and it's villas they're trying to liquidate. So it is on resale, like it's good ROI, yes. However, very difficult resale. And another thing is all Asian countries, they have very high humidity, which impacts the quality of your property a lot after a couple of years, and you need to do renovations pretty often. Next one would be Oman. Oman prices now, by the way, went up after the conflict started because a lot of people who just needed to put their money, to park their money, they decided to do it in Oman. There are a lot of developers there, some of the Dubai developers as well. I mean, they're building in Dubai and they're building in Oman. And Oman is more emerging market in GCC and more long-term perspective. So I would say if we are hitting recovery in 1 year, this will not still pick up until then, right? So this still will be slowly growing market, but it has a good potential as well. Price is $2,000 to $4,000 per square meter right now. The prices are more attractive than in Dubai. Rental yields 5 to 7%. Limited supply in prime coastal areas. Vision 2040 of the government, tourism and infrastructure expansion, and new master developments. Increasing foreign investor access, meaning they give more and more freehold to international buyers. Foreign ownership in designated zones. Golden visa, same as in Dubai, same 2 million investment. I mean, it's like equivalent of 2 million dirham investment. Long-term residency available. Freehold rights and approved projects. There is one downside of Oman, though, is they introduced income tax. For now, it's only 5%. However, still income tax means your capital gain tax and the income from your property as well. And residents taxed on worldwide income as well. If you're a tax resident there, whatever you make worldwide, you also pay there. Exemptions, primary residence sale, if you're selling your home, and inheritance. Deductions for education, healthcare, and charity, and insurance. And now we move to a very interesting topic, is current offers from developers. So my favorite offers now are actually from Shoba. Shoba offers 40/60 payment plan for 4% DLD waiver. They say the DLD waiver offer finishes today, but I think we can do something. Not only 40 to 60% payment plan we can leverage, but we can also put 10% down payment and 10% we can push to further. Damak is another amazing offer. 50% payment plan, 4% DLD waiver, and Nissan car or cashback. So if you're buying property worth of 1.5 million dirham and more, you will be entitled for this for Nissan car offer, depending on what is the worth of the property. I put Damak twice. IMTIAZ 35/65 payment plan and 4% DLD waiver. Aldar, government developer, not very often they have this kind of offers, but also 50/50% payment plan, 10% down payment, and 2% because it's for Abu Dhabi project, 2% registration fee waiver. In Abu Dhabi, it's still 2%. Benghazi offers discounts case to case, I would say, and on bulk deals. So if we have bulk, they consider from three properties. So I would say if we have 5 different investors that are going to make a group all together, we can push for the bulk offer. For 3, I don't think so because it's different names, but 5 and more, I think they will be happy to do so. And many other actual developers, it's just too many of them. There are smaller developers, boutique developers that are offering post-handover payment plans or discounts, or also almost everyone is offering now DLD waiver. So I think it's a really good opportunity to use these kind of things. And these are official discounts because they cannot also announce everything what they want. They can introduce different kind of incentives, maybe even service charge waivers or something like that, but they cannot announce a real discount. Why? Because they have investors that bought 1 month ago. If they are putting discount, they are screwing them. So they will never announce it publicly. So what they do is we go there, we choose the unit, and then we push them as much as we can. So I am done with my presentation. I hope it is informative, and I hope you have an understanding how the market is moving and how it is today, and what to expect in the nearest future. As I said, the best strategy for off-plan investors would be to leverage on the offers that we have now and to negotiate more upon booking. And for those people who are sharks and who are just wanting to buy in the low and who have cash ready to pay the whole amount, why I'm saying cash ready to pay the whole amount? Because if the prices drop too much, more than 20%, banks will not give mortgages that easy. So they will be much stricter, and a lot of people will not qualify for mortgages. So that's why if you have cash and if you're ready to like shoot anytime, I would say 3-4 months, and you will have really good offers. Even though now we see some offers, because don't forget, hospitality and events industry, these were already hit. This is where people already started to feel the pain. And these people, if they have properties, most probably they will sell to support their businesses, because they need to pay people who are working for them, right? And to sustain somehow, and or they're bankrupt. So this kind of people will sell. If trade is not restored completely, and logistics and traders also will be impacted, and they will also be more flexible to negotiate. So you will have your good time. Please let me know if you have any questions. And I don't see any questions, and there was nothing asked here. Okay, then I think it's enough for today. I will do more of the webinars soon, probably once a month and once in a couple of weeks, where we can discuss all of that. Thank you.